Well, welcome to the Money and Finance for Expats podcast. Let's bring on the stars of the show for this, the 25th of January 2023 from Fiduciary Wealth Management. Let's welcome Paul Correa and Matt Penfold. Gentlemen, how are you today? Let's start with you, Paul.
Very well, thank you. Happy New Year to begin with. Yeah,
Oh, and an
E-
over to you
every,
from Portugal as well.
everything is good. We're looking forward to an amazing 2023,
It's great to
full
be back.
of positivity and expectation.
Yes, nicely put. Positivity and expectation. Do you have some keywords as well for 23, Matt Penfold?
It's difficult to follow Paul with that, but yeah, positivity. It's going to be a great year. It's interesting when you introduce it. You said 2023, and you think, God, where did that come from?
Yes.
Wasn't it the 90s yesterday? But no, I think it's going to be a really exciting year for us. We've got a lot of plans. We've got a lot of exciting content for the podcast as well going forward. So no, we're looking forward to it. And Carl, happy New Year to you as well.
Thank you so much. So let's just start. We were excited to be back here for the new year, talking about, of course, money and finance for expats. Where do we find you? For people who aren't used to you, can you give us a quick idea of where you are in the world, and a little bit about the company, Fiduciary Wealth Management, before we get started?
Yeah, Fiduciary has been serving British expats in the Iberian Peninsula and the UK since 2007. We've got legal roots and we're also part of a global accounting network. So we're quite unusual in that our practice has accountancy and legal roots. And we're extremely passionate about serving the British expatriate community. We're not serving every expat. Our focus is predominantly on the British expat community, principally because we understand the interaction and the nuances between UK taxation and the new country of residence, whether it's Spain, Portugal, or Gibraltar. But it's all about cross-border tax, financial retirement planning, and of course, wealth management advice and insurance and protection, and you know, second opinion services. And there's peripheral services that we offer. I think outside the scope of this podcast to go into the finer detail, but we think that we can help a lot of experts out there. I think they're getting shortchanged for advice. I think often they're paying too much for the service and for the quality and for the products, and we are ready to change all that.
All right, and anybody who wants a second opinion on that idea that they might be paying too much for the service they get with wealth management, check out fiduciarywealth.gi, and we'll make sure you've got all the contact details for getting in touch with Paul and Matt. You're in Gibraltar, right, Paul?
Correct.
And Spain for you, I think, Matt, right?
Well, a bit of both. So yeah, I'm at the office here in Gibraltar, but I live in Spain. So yeah, best of both worlds for me. I enjoy my home life there and my work life here. So at the end of the working day, I can escape Paul and run across the border to Spain for a bit of
Yes,
freedom.
it's amazing.
Um,
Say to your kids in the morning, I'm just going to another country to work. Incredible.
yeah,
Really.
I think it's quite unique to apart from all the other people here, but to kind of cross a border every day for work, I think it's quite unusual. But
Well,
no, I
well,
mean yeah.
sorry, it's not unusual actually. It's the same as France with Monaco. And
Yeah.
I only say this because I tripped into Monaco once from Nice and from the Côte d'Azur. And it's pretty much the same. The only thing, there's no barriers. There's no police control. You don't know you've left France and you're in Monaco. It
Sounds
is
good.
that unusual.
Living the
It
dream. That sounds so beautiful. You in your Aston
oh
Martin with the top down. It must happy times there, Paul. Fantastic.
yeah. I wish we had that here though. Sorry, Matt, I interrupted your flow. Apologies.
No, it's okay. It's okay. No, I'm just basking in the enjoyment of here and yeah, and part of my commute to work, Carl, is crossing the runway. So yeah, maybe that's a unique part, Paul, isn't it? Crossing the runway to get
Lovely.
to the office every day. Yeah,
And ducking planes as they land and take off.
exactly. Yeah,
How
It's an
exciting.
exhilarating experience. Carl, you should try it.
What a world you work in, guys. Finance and Global Roundup. We will be doing that every week. And we're taking a big picture look this week. Investment outlook for 2023. So I imagine that what will be a regular part of the podcast every week, the Finance and Global Roundup. You'll be talking about that within a bigger picture, I'm sure this week, where our special subject today is the investment outlook for the year ahead, Paul, right? And you're going to talk us through that. We welcome questions and comments, so pop those in the chat and we'll get to those. We'll do our best to get to those and get answers to you today. So, Paul, 2023, what were the words you used? Excitement and positivity.
And positivity.
Yes. So
A
go ahead.
year of
How's it going
change and transformation for those who are prepared to get the bull by the horns and have no limiting beliefs and just believe that you can take off. You just have to change your mindset and your story. Yeah.
Yes, well, that's a very interesting point. And is that part of how you relate to clients? Then it's not just a matter of the digits on the page and the hard finance. It's also about changing one's attitude. Is it? Is that part of the
I-
service you offer?
Well, in a market like this, you have to also educate clients
Right.
and set realistic expectations. Yeah.
Okay.
And I think it's part of having this honest, brutally honest conversation with your clients because you want a long-term relationship with them. You're not going to tell them what they want to hear if you don't think that that's true, right? We've never done that, and
Mm.
we know that we pay a price for that brutal honesty, but we're not going to change our ethos and our values to drive more business. I think it just doesn't feel right.
No, fair enough, and people will welcome that. If you want it sugar coated, do not talk to these chaps. They're going to give it to you straight, and you're also good for when it comes to debunking some of the acronyms and gobbledygook, if I may refer to it as that, within this sector and industry. Right, we've got PMIs to talk about this morning. We've got durable goods and golden crosses. We're gonna demystify all of that, to give people a picture of what
Absolutely.
will be happening for the year ahead. So, where would you like to start with this?
With the EU consumer confidence data that came out on Monday, the 23rd, I mean, just to explain to the audience, the consumer confidence is an indicator of future change in household consumption and savings, and therefore it's a sentiment indicator of the general economic situation. It came in at minus 20.90, showing a slight improvement from prior monthly releases. So I think the assessment, the conclusion to arrive from this data is that the European economy is perhaps more resilient than the US economy,
Okay, and there
and
we are. We're
certainly
looking at the
consumers
graph
feel
now.
that. So
Oh,
yeah,
okay.
you've got the figure there. It's yeah. No, no, that is the PMI. That is not the correct one.
Oh, I do beg your pardon. Okay, so
There's a
that's where you need to help
there's
me
an
then.
order.
Okay, I've
It's
got PMIs for EU,
I
UK,
know that
US.
there's no graph for this one.
I
There's
beg
no
your
graph for
pardon.
this one.
Okay, thank goodness you're here to educate us on this matter. So yeah, I beg your pardon on that. We'll
No,
come
no,
to that
that's
in
fine.
time. Okay, and you'll decode PMIs for us
I
this.
will decode PMI and all the acronyms. So the second data release that we had on Tuesday. What day are we today? Wednesday. So yesterday we had the EU Purchasing Managers Index. This
Ah, there
is
we go.
an index of the general direction of economic trends in the manufacturing and services sector,
Right.
and it increased from 47.8, the reading, to versus 48. Sorry, it increased from 47.8 last month to 48.8 versus an expectation of 48.5. Let me set the scene very clear here. If the Purchasing Managers Index is below 50, it points to economic contraction. The economy is slowing down, possibly going into recession. If
Okay.
the reading is above 50, it means the economy is either flat or growing, right? So I think what the data shows is that there's an economic contraction in Europe,
Yeah.
but perhaps it's mildly than initially anticipated. So
Yes.
this goes hand in hand with the EU consumer confidence, which pointed out the same thing. Consumers think that the economy, uh, whilst contracting, they have the confidence that the any recession, any slowdown is going to be milder than they anticipated. And this index of economic trends in manufacturing and services sector says exactly the same thing. Yes, we are still in contraction mode, but we're bouncing back. So the EU economy, the eurozone, seems to be probably in better shape than the US.
Okay. Finance for dummies then. It's called the Purchasing Managers Index. What are they purchasing? What are they managing? Who are these people and how has this come about?
No, it's just it's a measure of the manufacturing sector. They provide data about
Ah,
services and manufacturing, and then
oh,
based on that data of how much they are producing and manufacturing, they have a gauge for economic activity.
I
So
see.
basically, yeah, it points to a softer contraction in factory activity than expected. So
Okay.
again, I repeat, I think a bit more optimistic outlook for the EU,
All
which
right.
I think is really good.
And the importance of looking at this is because it's about manufacturing. This is a real determinant of the powerhouse of an economy, right? We're not talking about moving money around here, are we?
No,
We're
no,
talking
no.
about
This
things
is
being made.
exactly,
Yes.
exactly. This is a true indicator of economic activity and the health of the economy. That's why
Yes.
the purchasing managers index is a data release that is followed very closely by the market.
Okay. And the big dip that we see there, I mean, that's when you look at a graph and you suddenly see a great dip there, was that during the pandemic there on the left of the screen?
Well, there's been a gradual decline since, let me see, 31st of December.
This is we're
Yeah,
looking at a 5-year picture here, aren't we, on the
we're,
screen?
we're looking at a 5-year picture,
We are, yeah.
and what you can see here is that the economy has, we had the dip there was a recovery just after when the economies unlocked.
Yes.
So it bounced back strongly and then continued recovering. It was looking very good. And then inevitably, when you start raising rates and ending quantitative easing, then there's not enough oxygen in the bloodstream to keep it going.
Yeah.
I think that's the analogy I would use.
Okay.
So
All right.
no, that's and then we can move on to the UK PMI, which was also released yesterday, and I think the data came in at 48 from 49.9 last month, and the expectation was 49.7. So this only goes to show that the pace of slowdown is picking up in the UK. So the UK economy is slowing down more aggressively than the EU, and that makes a lot of sense because the US economy, the UK economy is more aligned to the US economy because of intertrade than the EU.
Okay.
So it goes to show that the EU economy will be more heavily influenced not only by domestic factors but also by a weaker US economy.
All right, superb. And we can move on then from the EU as a whole and the UK that you've just commented upon there to the United States.
Exactly.
All right.
Interesting reading.
Okay.
What does this show? Again, the V-shaped, the lockdown, more money printed, bounces back quickly. Then end of the lockdowns, it shoots really high to a PMI reading of 70, which is incredible.
Yes.
But then in the last year, it has slowed down considerably. So again, it shows a reading came in at 48.4 versus 49 the previous month. So the slowdown continues. The tail end of the graph shows that it's still in decline, and it's down from 58.8, as I said, a year ago. So
Mm,
the economic contraction in the US is gathering steam and is being weighed down by the higher interest rates and by the end of quantitative easing. So the three blocks and economies, I think it's evident and clear from the PMI reading that the US economy is definitely heading into a recession. What kind of recession we'll cover later, yeah?
okay.
Because
Interesting.
no one knows.
All
But
right.
the reading is well below the 50, which would be a flat economy. So it's
Okay.
in contraction mode, but the tail end of the graph shows that the slowdown is more pronounced than it is in the UK or the EU where it's looking better. Yeah.
All right, just giving people a comparison of those. Is
Yeah.
it generally the case then that in the US it looks a little bit more dynamic and changeable in that picture for
Well,
the PMI in
because
the US?
they move very quickly. I
Yes.
mean, this is the beauty of technology. In the last 30 years, economic data would come in, it was unreliable, it took longer to gather, so the policymakers were also always behind the curve. But with new technology, with big data, algorithms, and technology, the data comes in quickly. And if the central banks are quick off the mark, they can change fiscal and monetary policy to either stimulate or dampen demand in the economy. I
Okay.
think that's what it shows.
Very good. All right. That's the PMI then. Some of us will now understand what that means, and I'm sure they are graphs that we will return to in due course as we analyze these things weekly on the
Absolutely,
podcast.
because I think it's very important to share this information with our listeners and with our listeners and people who subscribe, because it's important. If they've got their investments and their pensions and their savings tied to the market, that they understand general economic trends.
Yeah, good. Okay, that's really helpful. Thank you very much. Do we move on now then to UK public net borrowing as an indicator of what might be happening?
Yeah, I mean, this data, what it tells you is the relationship that exists between public sector income and expenditure,
Yeah.
and which then leads to changes in deficits and debt.
Okay.
So I think it's a very interesting piece of data. And what we saw, I think it was yesterday, we had the highest. Well, let me tell you, in November, we had the highest. We've had the highest borrowing figure in November 2022 for 30 years. And that was due to energy bill support, you know, all the um, all the um, yeah, all the credits that were given by government to people, so they can reduce their energy bills during the
Mhm.
winter months.
Yeah.
So, and it also reflects the impact of high interest rates on the public sector debt, the UK
Okay.
public sector debt, right?
Yes.
That was November. December's figure was even worse. I mean, it came in yesterday at a deficit of 27.4 billion pounds.
Yes.
So there's a gap between public sector income and public sector expenditure. The gap is 27.4 billion. That is the highest December figure since records were began in 1993. Before, they didn't used to release this data. So it shows that the deficit is growing.
Okay.
The deficit is growing. And remember that the deficit also grows if UK interest rates rise, because there's a debt servicing component which increases the debt. So it's a
Yes.
double whammy. Yeah, your debt is growing,
Yeah, and you've got to pay
and it's
interest.
growing more if you start raising rates, because it costs you to service that debt.
Yes.
So you get
Yes.
hit twice.
Okay.
So that is a bit worrying,
Yeah.
that the UK is in such a yeah, has so much debt.
And then the
Um,
impact then, Paul, for your focus is on Brits in the Iberian Peninsula. What is the direct impact of what we're seeing on that graph in terms of
well,
their
I
personal
mean,
wealth?
well, the direct impact is a difficult one to say. Look, the UK government has to raise more tax receipts, more tax revenue.
Mhm.
So they have to either increase taxes to bring income and expenditure into balance, or reduce their expenses. And they can reduce their expenses in a number of ways: cutting public services, you know, reducing their probably over bloated civil service. I'm not talking about NHS before anyone says anything. I'm
Yes.
talking about other civil servants. Ultimately, your income and expenditure, like a household, right? If you are
Yes.
spending beyond your means, at some point you have to bring it into balance. Now, if the debt continues growing, they have to issue more bonds and more liquidity into the market to raise finance, and that could potentially, more debt in the market, that has its own implications, yeah,
Okay.
for the
All
economy.
right.
So it is a very worrying trend when you're running huge deficits and they keep growing,
Yeah. Okay.
because
And there it
something
is.
has to change, right? It
Yep.
doesn't change on its own
Yep.
unless They're just prepared to run these huge deficits in the hope that there's economic turnaround, and then their revenues exceed their expenditure, and then they start repaying. But right now, it's looking bleak from
It
where
is,
I'm
isn't it?
standing.
And people can see from their own experience, can't they? That massive spike in 2020 was presumably when the British government, UK government, borrowed loads of money to fund furlough and the way that they managed the pandemic.
Correct. But look, what's interesting, Carl, and you raised a very extremely good point. You're right. That spike was because they had to borrow excessively to keep the economy on an even keel. But if you look prior to that, it was pretty consistent, right? In
Yeah,
terms of the public sector borrowing requirement, there was a bit of oscillation, but the volatility was within very predefined narrow ranges.
yes,
And you can see the spike, then it recovers, and you can see the spike again because because the economies are not in good shape,
yeah.
and you start increasing rates on top of that, then the situation only gets worse.
Mhm.
So I think the global economy is not on a very healthy footing,
Okay.
if I may say so.
No, fair enough. And you've given the reasons for it there. Where do we go next then in our analysis?
Well, we have one more graph, which is the US durable goods orders. That is due to be released tomorrow. And this is an indicator which measures broad industrial activity. Um, and I think we should expect the durable goods data that comes out to show that the US economy is softening.
Hmm.
Um, we will know more about it tomorrow when it's released. But I think the expectation is in line with the consumer confidence and the PMI, US PMI. I think it will point to a decline in industrial activity, evidencing a major slowdown, and I would hasten to add probably a recession of some kind.
Right. Okay. And it's interesting, this, isn't it? Because a lot of people feel a recession, don't they, in the effects of it, and wait for governments to declare that it is the case. I mean, many people are feeling this in their own experience, but it's not official until it's official. It would appear to be what happens in the world.
Absolutely. I mean,
Yes.
it's not official because the data takes time, and the fiscal and monetary actions that central banks take, it takes a while to feed through the economy. And I
Yes.
think the question is, Carl, is whether the US will avoid a recession or progress towards a soft landing,
Yes.
or a hard landing. And the jury is out. Most analysts are expecting a shallow US recession, but it's the largest economy globally. And if they catch a cold, then this has uh, implications for other zones, whether it's Asia or Europe or the UK, and it will spill over inevitably to global markets. But I think what we're seeing here is that we're definitely, the US is definitely heading down a slippery road.
Okay.
And I think over the next quarter, possibly into the second quarter, between now and April, May, we will have a better idea of the severity of any recession and what
Okay.
the implications are, and central banks will pivot based on the data as it comes out.
All right, there you go. We're looking at the investment outlook for 2023. Some great information there. Thank you, Paul, for that. Are we looking at gold prices as well on this occasion?
A bit later on, yes, a
Okay, all
bit
right,
later
fair
on.
enough. We'll hold that for the time being. Let's go to the comments that have come in. We welcome such comments as "Hi, Paul and Matt, both looking well from Paul. Carl always does. It's the makeup. I refute that accusation there. All natural here. To me, Facebook user says it appears that the global financial pattern will follow history. Irrational exuberance followed by crash back to reality given the macroeconomic conditions. Hopefully, we can see short-term gains in stocks, metals, commodities, cryptocurrencies, etc. Pump and dump the gains before the next crash. How would you respond to that, Paul?
Well, I agree with Paul. I think you know um, there's patterns in history which keep repeating themselves.
Yes.
Uh, Policy errors that lead to economic decline, and then the right fiscal and monetary measures which result in in periods of excessive growth or high growth.
Yeah.
Um, but Paul is I would agree with him. There's a pattern here. It's happened before in history. If you look at the history books, um, and you have to recognize those patterns, and you have to know how you're going to make maximum take maximum advantage of that pattern. How do you
Yes.
position yourself in light of what we're seeing? Um, but no, I share Paul's
This is
views.
somebody else, actually. Paul may well have this as an opinion, but this is somebody else, a Facebook user. You might want to tell us who you are. You might not. You might be a billionaire who prefers to keep their identity to themselves and is just popping in for a bit of insight from Paul and Matt this morning.
Well, but,
They
but
all,
there's one thing I'd like to add. I mean, whoever's made that comment, I think it's true about those patterns in history,
yeah,
and you have to, you know, be mindful of history because it repeats itself, and history doesn't always rhyme, but it repeats itself.
hmm
Um, but we are in an unusual. We are in winter, right? And the spring will come. It's an unusual time. In if you look at the history and 100 years from now and then look back, it's quite unusual. In the history of the monetary system, we've never been in a situation where individuals had to pay banks for the privilege of the banks taking your own money and
yeah,
then lending it to someone else. And
yes,
that's because the pricing model of banks is such that what they do is you place the deposits, they take a margin on your deposit. So if the rate is 7, they pay you 6. They take a margin on the deposits, and then they use the money to lend, and they make the margin again
hmm
on the lending, right? So they win on the deposit and on the lending on both sides. And the more deposits they have, depending on capital ratios imposed by regulators and central banks, the more you can extend credit. Now, how unusual, it's never been seen before that you had to pay the banks to take your money. I mean, the system has been distorted to such an extent. Who would have thought that 10 years ago, 20, 50, 100 years ago, that you had to pay the bank? And what we're seeing now is a return to the mean, a
yeah,
reversion to the mean. We're going back to what it should be. But because we got so much debt, it's a painful process, right? And
yes.
and the question is whether they'll continue doing this and kick the can down the road, or they're going to accept that there's going to be a lot of pain, and the pain is going to be very painful.
What the longer it goes on without
The
some
longer it
sort of
goes on,
yeah,
it's like the heroin addict that rather than go cold turkey keeps taking more heroin.
yes, yes,
Either it ends up
unsustainable.
killing you,
Yeah,
right? It
yeah,
ends up killing you, or you have to go through a major metamorphosis in your life where you realize that the error of your ways, or there
yes.
has to be a reset in the economic system.
Is the banking industry any likely anytime soon to realise the error of its ways, or will that force come from externally?
Well, I think that the banking system recapitalized itself during the global financial crisis.
Yes.
So they replenished their balance sheets to be strong. So I don't think, and then they became more restrictive in their lending. So, and banks are now a completely different animal to what they were in the global financial crisis. So I
Okay.
don't think right now it's a banking problem. It's just the global financial system and central banks overextending themselves. And I think the question, Carl, is um, whether we're heading to a mild recession or a deep recession. And who knows, it largely depends on whether the Federal Reserve's pivots on rate hikes and starts another round of quantitative easing maybe in the second half of the year. And I see a range of scenarios here. One is there's a deep recession and stock markets collapse completely.
hmm
That is a real possibility. A shallow recession and stock markets either drop marginally or maybe trade sideways, because remember, the market is always ahead of the game. So they may think, okay, yes, we're going into a mild recession or shallow recession, but it's going to be short and we're going to bounce back. And therefore, because we're going to bounce back and we are 6, 12 months ahead of the economy, we're going to price in the rebound rather than there's a shallow recession. Markets are strange animals. They're looking at the data and looking forward rather than backwards. And the third scenario is an all out recession, but the Federal Reserve, the U.S. central bank, starts cutting rates very aggressively, very quickly, and do more money printing and quantitative easing to reverse any damage from the tighter financial conditions. And I think we all tend to forget. Everyone's talking about inflation, which is, of course, the dirty word right now, and understandably so.
Mhm.
But I think we mustn't forget that the Federal Reserve has a dual mandate. On the one hand, they have to ensure the stable prices, which central banks have defined as inflation of 2%, but they also have, as a second objective, maintaining maximum employment. And the problem is that the objectives are in contradiction with one another right now, right?
That's a problem. That is a
If
problem.
they fight inflation, they start getting massive unemployment and vice versa. And what
Yes.
they're trying to do is to juggle those two balls and hope, cross their fingers and hope it's a soft landing. And if they get it wrong, they have to undo the damage quickly and start cutting rates. That's why the market is already kind of smelling the Federal Reserve, you know, bringing out the white flag and saying, "Okay, we are done."
I
But
don't.
who knows? Who
I don't
knows?
think Calvin Klein are working on a fragrance called the smell of the Federal Reserve. It's not a good. It's not a good aroma right now, is it? That's
It
the
cannot
problem.
it cannot compete right now with Christian Dior or Sauvage. But hey,
Okay, so there you go. Matt, I know this is Paul's area of specialism, and hence why he's a little more vocal than you are on this particular episode. Is there anything you do want to add to this?
Carl, Paul's more vocal than me on every episode. Don't worry about that, and every subject. So this isn't, just to this. But no, I mean it's there's nothing there to really disagree with. The one point that I wanted to make, and we had the previous comment, and they identified a lot there. But they said something. Oh, hopefully make some short-term gains on stocks, commodities,
Yeah, this is here.
um, yeah, metals, cryptocurrencies. But it's not the approach that we want to take, and chasing these short-term gains is a very, very dangerous move. You could
Yeah.
come out of it. Look, but there you're not talking about. You're moving away from investing and more talking about gambling. I want to make these short-term gains now,
Mhm.
because when do you stop? When is the time period? And that's a difficult thing to identify. So I think that's something that people have got to be cautious with. And I think it's boring that we always repeat it, but it's true. You need to take a long term view, especially in markets like this, especially in an economy like this when things are volatile. Yes, you need to take a long term view.
Yep. And so up to like 2028 and beyond. Paul, talking to other Paul here, sounds like long-term investment, not short-term investment. To
but
echo what you said as well, Matt, investment 5 years minimum. Would you agree?
but Matt is spot on. I think with his comments, I fully agree with every word he said. I
Yeah.
think you have to look at the long term. But as I said, after winter comes the spring. If you look at I think Paul Richards mentioned the history books and so on. If you look at the history books and you do a graph going back 100 years, you'll see that after, the Great Recession or whatever it is, the global financial crisis, you know, just when they start pumping liquidity into the market or just when the market turns round, the gains are exceptional.
Mm.
So it is a long-term gain, and Warren Buffett has been playing this game long enough, and he sees a decline in markets as an opportunity and not
Mm.
a threat. But what
Yes.
you can't do is let your emotions run riot and dictate and rule your head. You have to remain calm
Yes. Which is part
because
of his
the market doesn't discern between good assets and bad assets. If the market declines, sometimes it drags almost everything with it at the beginning, and
yes.
then some assets will outperform.
Okay. Thank you, Facebook user, or FU for short. Of course, it's dangerous. That's why you sell after the long term gains, the pump and the dump. And you also said, what about, we've talked about this before, haven't we? But so you may want to address this briefly, Paul. What about supply side economics instead of raising taxes? Could you decode that for us first? And then what do you make of it?
No, I agree. I mean, basically, what it means is that if there's supply constraints in the market, rather than increase taxes, what you do is you increase the supply.
Hmm.
So let's say energy, there's a supply crisis or a food crisis, but with energy, it's because of Russian natural gas. Rather than um, raise, in a scenario like that, where there's a supply constraint, rather than look at the other options, what you need to do is find ways of increasing supply to bring prices down.
Yeah.
So I'm assuming that's what he's referring to. And if that's the case, yes, I would agree that you have to look at your supply side
Yep.
and see
Okay.
whether you can address supply side issues as opposed to demand
Yes.
side economics. Yeah.
And not the wonderful conversations we've had previously, just making creating more money and pumping that in, not the supply of money, but the supply of tangible and real things.
Yeah, of tangible goods.
Yes.
If you have an imbalance between demand and supply, then you have to adjust your supply accordingly. If it's because the supply is not there because of an energy crisis, the war in Ukraine, then how do you find alternative um, sources of supply to bring price back into equilibrium,
Yep. Okay. That's
rather than let prices go up to $100 a price a barrel of oil or whatever.
Yep. Okay, that is the point that Facebook user was making. I want to ask you about hidden taxation and also bail-ins as well as bailouts. We may be running out of time today. And we can carry it forward to next week because we certainly need to take this big investment outlook picture for the year and
Yeah,
see how you factor that into how you help people on a practical basis. We need to do that today, I think.
yeah. I think we start with precious metals. I think the market environment is starting to become more favorable for metals, which are still deeply undervalued. We've seen the strong headwinds for gold and silver um, in 2022, and they were rising U.S. interest rates. And but we're now getting to the terminal rate, which is the highest it can possibly go. Although no one has a crystal ball to decide and determine what's the maximum they will go, I think we're getting to the end game because of the cost of servicing the U.S. debt.
Hmm.
So we've had so the higher rates, I think, have been very damaging for precious metals. And then of course the high interest U.S. interest rates attracts foreign capital inflow, which strengthens the dollar, which is another strong headwind. So those are the factors that have been weighing heavily on on gold and silver. I think we've seen the US dollar rallying strongly. I mean, there's something called the dollar index, and it's gone from a reading of, it went to 115. So it was about 90, and it went. So it means the US dollar increased like 25% in value in a very short space of time in 2022. And that was damaging for gold and silver. It has since retraced, and I think I've mentioned in another podcast, it retraced from 115 to 102. So the US dollar is now losing value against a basket of currencies, probably because the market is anticipating US rate cuts soon, whereas other central banks have been slower in increasing their own interest rates and have to increase a bit more. So I wouldn't be surprised to see the US dollar decline another 10-15% in the next 18 months.
Okay.
And another development that we are seeing, and which is a very interesting development, I think, from the precious metals space, is that there was a lot of short selling in the marketplace. So people with leverage position, traders with leverage position, they invested $1 and they could trade for 25 times that. So it was
Mm.
heavily leveraged, and they were short selling futures in gold and silver. If you look at all the anecdotal evidence, it is starting to dry up. And the next wave that we're starting to see is that some futures traders are now betting for higher prices, and they're starting to go long rather than short. So the first wave is drying up. The short selling is now petering out. The second wave is that traders are now pivoting and they're going long, they're speculating long. Still early days, but we can start to see the trend. And I think the third wave is when investors, whether they're institutional investors or retail investors, they go, you know what? We're starting to see a turnaround here. And they go back into the market and increase their holdings. I think the really important point to make here is it doesn't take too much to move the gold and the silver price, to move it up vertically,
Mhm.
because it's a very small market in terms of size of total assets under management. And if you look at current average holdings in investment portfolios of retail investors globally, I think they have something like 0.2% exposure to gold and silver. We have much more than that. So all it takes is a marginal increase to say 1% of the investments in gold and silver. That would be a five-fold increase in price. So there's a lot of upside potential there. Um, but why do I say that metals are fundamentally cheap? There's a few reasons for that. There's been a massive lack of investment in new mines, so there's supply side constraints. So lack of capital expenditure in um, in mining. It's one of the sectors with the best free cash flow yields. So it means that they're piling cash reserves rather than investing in new capital projects, new mines. They're hoarding their cash. So in other cycles in history, we go back to history. They've reinvested the money in new mines. They're not investing in supply. Um, Central banks in 2022, at the tail end of the year, they started being net new buyers of gold, so building up their reserves. Remember, I'm still a great believer, and you can mock me if you want, that the easiest way to reset the economy is for central banks to increase their gold reserves and then allow the and stop manipulating the price and allow the price of gold to find its true value, because then the reserves would be worth five times more, right? Or the gold reserves.
So why wouldn't they? Why does that
Why
not happen?
wouldn't they?
Why does that not happen?
I don't have the answer to that one. There are reasons, but I
Yes.
don't
Okay.
know them.
Right.
But that's exactly what they should do. So
Yeah.
central banks are starting to buy gold. This is not us making a statement. You can go online and search and see if central banks are now net buyers or net sellers of gold. And you
Mhm.
see the trend has changed now. So that's a very strong indicator that we are set for a good 2023. Um, and then, of course, if you look at silver in isolation, it's an important metal in the electrification of the global economy. The
Yes.
shift to green, right? Because silver is a conductor of electricity, and in besides, the jewelry and all the other stuff, and potentially a reserve currency, reserve, it also has some industrial use, and they're trading cheaper than ever. So yeah, we fundamentally we are very positive on gold, silver. I mean, we are positive on copper. Don't get me wrong, Doctor Copper. I mean, copper can go to $10.
Mm.
It's 4.20 now. I mean, $4.20 could go higher. But let's look at the technical indicators you alluded to before, Carl. They're very really important because they also paint a very positive picture. The
Okay.
so-called golden cross, which tells us that we are. It's technically. I mean, this graph is not the best, but it's a golden cross, and it's a technically a bisignal. Why is it a bisignal? A bisignal occurs when the faster moving 50-day moving average of the price of gold or silver, I think it's gold in this particular instance, moves or crosses the slower moving 200-day moving average, which means that in the short term, the price is starting to go up more rapidly than the average over 200 days. And that occurs at the tail end where the my eyesight is not very good. The 200 slower moving 200-day average is the green
Oh yeah.
line, yeah?
Yeah.
And the purple line is the 50-day moving average, which is faster moving. And if you see here, the purple line has just crossed the green line.
Yeah.
And it happened as well. I can't see because you've got investment outlook
20,
here, but
2018, a long time ago.
in
Absolutely. Yeah.
2018, but it happened here as well. If you take investment outlook, you look at 2008,
Yes.
and you have the 200 halfway, sorry, at the
Yes.
beginning of 2009, the
Yep.
50-day moving pink line crossed the 200-day moving average green line quite aggressively, and then they had this amazing bull run in precious metals.
Mm.
So why is it significant to look at this technical indicator? One which neither Matt or I look at frequently, and we're not great believers in that technical analysis. But think about this rationally. Um, the reason why technical analysis works is because it's a self-perpetuating prophecy.
Mhm.
And why is that? Because if enough traders pay attention to these charts, it influences their investment psychology. And because it influences the investment psychology, it then influences their buying and selling decisions. And if you haven't heard a community of technical analysts that have leveraged, many of them do leveraged trading, if they are all thinking, wow, the 50-day moving average has just crossed the 200 moving average line, this is a really strong buy signal, and everyone acts on that, then it'll drive the price higher. So I'm not a great believer in technical analysis, but it seems to validate a trend
Very good.
because everyone will follow, and then you've got the retail investors tagging behind that. That takes it even higher.
Excellent.
So,
Thank you very much, Paul, for that. Yes, metals are likely a good investment right now. I agree. And another validation of your analysis this morning. Good job, Paul. Good overall evaluation of the economic situation, especially when you agree with me. I'm just jesting, of course, there. So thank you so much, Paul, for that investment outlook of 2023. I'm talking here with Paul Correa and Matt Penfold of Fiduciary Wealth Management. Suggest you do the same. People can get in touch with you and you can help them with their wealth management in a very comprehensive way, especially Brits and in the Iberian Peninsula as well, with all of the practicalities of the move as well as the intricacies of wealth management as well. Problem, says Paul, is the older you are, the window of time becomes narrower. So the long-term view is a concern, not necessarily financial, but quality of life. There is that, but also when you're talking about wealth management, you're talking about for the children, aren't you, and the grandchildren as well. You take that long view.
well, of course, because well, you're managing. You have to ensure that the retiree or whoever it is can sustain their lifestyle in retirement, or they're still active in business. But equally, there's an intergenerational wealth transfer issue that you need to account for.
Yeah.
So yes, you're right. I mean, if their finances don't stretch enough, it's about maintaining that lifestyle during their lives. If it is a considerable amount of wealth, then they have to live a good life and think about passing it on to the next generation in a seamless and tax efficient manner.
Yeah, which of course you can help with. Anything else we should? I think it's about time to conclude. That was a very
Well, I
comprehensive.
we're launching two new products. They are an irresistible offer for the British expat community in Spain and Portugal.
Uh-huh.
It's the Spanish compliant bond and the Portuguese bond, but
Yes.
but we have revamped it, we have relabeled it, we have enhanced it, and it is an irresistible offer because it's currently unmatched in the marketplace in terms of the lowest price for establishing the bond. There's no one that can match us right now. The prices that we're offering, they are. We've kept it very simple, so we've removed all complexity from the equation, and then we've added a whole range of additional free benefits which offer exceptional value. Now, those free benefits were normally services in their own right that we used to charge for. We are we are bringing all this in. This is going to put an enormous strain on the business, and Matt has been cautioning us and cautioning on the logic and the rationale for doing something like that because it puts tremendous strain on the business, and but we're so keen to give better value because we think we can help so many expats out there in the marketplace. And we are passionate about serving the British expat community. And we genuinely want to give that value back. So this is not the time to go into the minutiae because it's outside the scope. And I think you're tired of listening to us, Carl. I can see the expression of tiredness in your face. But joking apart, but I think on the podcast of the 8th of February, we're going to talk
Yes.
about that. So I would urge all the listeners to subscribe to our YouTube channel, to like and share, tell other people within the expert community that we can add considerable value, that we're genuinely interested in helping our fellow Brits in Iberia, and that we are the go-to firm.
Very good. And that's quite a tease, that, Paul. If somebody wants to get involved with that product straight away and doesn't want to wait until February, can they do so?
Absolutely. They can call
Okay.
Matt or I or call a new business team,
Yeah.
and they can sift through and get the data and find out how we can give value. I mean, it is unheard of in the market,
Okay.
and we've done it deliberately. It might cause a tail in terms of turning things around because it's going to put us under tremendous pressure. But
Yes.
those who think about setting up a Spanish and a Portuguese bond come to us because it makes sense to do
And
so because
it,
of what we're offering.
it underlines and illustrates your maverick approach, I think, and slightly different approach to doing these things when compared to other wealth management companies, right?
I think
Uh,
so, Cole. I mean, Paul's alluded to it then, but I think it's a crazy offer. And Paul's talked me round, but it really is because, I mean, the one thing that we feel sets us apart is the value we add and the quality of our service. But for us to now put this in a package at this cost is, yeah, Paul
Insane.
knows it is insane, and yeah, and you can compare it to offerings from anyone else in there, and it will beat it, no doubt. And yeah, it is a bit of a tease today, and for those interested, they should subscribe and definitely tune in on the 8th. And you know, we packed a lot of content in today as well, and there's far too much to talk about in one podcast. So each week we're going to do a kind of roundup of what's happening. That can be various things that affect expats relating to their money and finance, you know, the markets or other factors. So we want to add that value to people. We want to engage with people and you know, help expats out there with that. So we will have that kind of regular content every week, and then a bit of maybe more kind of tailored content each week on top of that. So
And
yeah.
and Carl, you said an hour should be, you know, the length of the podcast, and we said half an hour. But I
Mm.
think since we have all three have spoken about content, I think it's looking more like an hour now, an hour's podcast.
It's heading that way, isn't it? And
It's
of course,
turning, yeah.
I'm sure we'll get more questions as well as the podcast develops. So when you see something, I'm talking to you, our listener and our viewer. When you see something that confuses or intrigues you about money, finance, especially if you're an expat, come with your questions and run them in front of Paul and Matt on this weekly basis on our new time of 11 o'clock Portugal time. That'll be 11 o'clock UTC, I think it's called, isn't it? So do join us live for that, or catch up, as Paul and Matt are saying. Subscribe on the YouTube channel to make sure you don't miss anything. And of course, ask questions in the social media space as well. And most importantly of all, to take advantage of that bond offer, Portuguese and Spanish bonds, fiduciarywealth.gi. And a last word from each of you, because we will be back next Wednesday at 11 o'clock in this new time. And we look forward to seeing you then again and hearing your questions. But last word to you then, Matt, first.
Yeah, no, I think next week we're going to be talking a little bit about exiting the UK properly, which is very important. We
Yes.
come across this a lot, people, and this can be aimed at people planning on relocating, or those who have already relocated, maybe not sure if they've done everything right. In our experience, there's a lot of people who haven't. So yeah, we'll have the weekly roundup, but yeah, please tune in for that. And like I say, to repeat what Paul said, subscribe. share the details with your expat friends as well, and we'd love to take questions from more people as well.
Great. So next week, leaving the UK for the Iberian Peninsula. Over to you, Paul.
No, I would echo what Matt has said, and I would go further and say, if our listeners have any themes, any subject matters that want to be raised, we'll consider them. As you know, we've got a pipeline. We've got the next 4 podcasts all lined up. We know what we're going to talk about, because we agreed we need to give structure, to give better value to our Brits living in the Iberian Peninsula. And that is what we're going to try and do. But we're always open to ideas and suggestions in terms of what to cover. And if they want a second opinion, they can, in terms of their retirement, investment and savings that they have either still in the UK or they have it with an advisor in Iberia, then give us a call, and we can't promise how quickly we can turn it around, but we can give them a quick opinion on how it could be structured differently. So we are here to serve the community.
Excellent. What a great note to end on. And here are those details for doing that. So take care. Bye for now. And we'll see you next week. Bye
Thank
from
you,
us.
Carl.
Money
Bye,
and
everybody. Thanks, Carl.
Ciao, ciao.